Everybody seems to be focused on interest rates globally, and definitely investors domestically watching our yields tumble from 324 down to 237 yesterday in 10-year. In your writing, you said the 10-year note has a short rate path dependency. I agree with that. Let's share it with the audience what you mean.
Sure. So, look, I mean, the reason why 10-year yields are low, it's not a mystery. It's really just math. So when I talk about a short rate dependency, really what the 10-year yield is it's like the overnight rate rolled over every day for 10 years. So if you have a short-term rate path like what the Fed has set out today through forward guidance, where they're not really going to move interest rates, I don't believe they're going to hike in 2020. But then if you believe at some point even in the future that there could be a recession, say in 3 years, and rates go even lower, once you take the average of that short-term rate over a period of 10 years, that brings down that long-term average for the 10-year note down to levels that I would say would be more fairly valued around 2.25%, possibly even lower, depending on what path short rates actually take. And that's why Fed policy is so important, not just to the front end, but also to the back end.
Now, let's stick with this theme. There's a lot of attention, and rightly so, to inversions in the yield curve. Now, when I look at inversions, I think about all the things that are going on to cause the curve to behave that way. And one of the issues is that there's an ongoing Fed presence raising short rates. I think that is not the case this time. Your thoughts?
Yeah, so the way that we at Morgan Stanley Investment Management are thinking about this for our clients is that effectively what the Fed is doing is they're keeping short rates higher. However, when we look down towards the longer term, as long as they've given us forward guidance towards a flatter curve, what they're doing is they're extending the economic cycle. So typically when people look at an inverted yield curve, they say, wait, that's a recession signal. But you have to ask why. The reason why is that typically the Fed tightens policy, increases short-term interest rates to the point where they're trying to cause a recession or significantly slow down the economy. That is not what's happening today. The Fed is saying that short rates are going to stay stable. However, that they don't really plan to increase those short rates over the long term. That brings down long-term rates. When you bring down long-term rates, one of the issues has been high levels of corporate leverage. It allows corporations to delever over time. It also reduces their interest coverage, meaning the cost of their leverage, and refinance their bonds at more attractive rates. All of this is positive. All of this extends the economic cycle and doesn't tell me that there's a very strong signal for a recession. It's an indicator. Flat curves tell you that there's slower growth in the future. However, the signal strength is relatively slow because we have to ask why the curve is flattening. Just not that it's flattening, but why is it flattening?
Excellent. That probably explains why there's so many corporations and even foreign governments doing some issuing, and they all seem to be doing it right here in USA.